Hey everyone, welcome back. Ready for another deep dive. Today we're tackling something called factor timing.
Factor timing.
Yeah, figuring out when to buy value stocks or maybe when those momentum plays are gonna really take off.
Mm,
For our listeners, they're wondering if there's more to it than just buy and hold. And honestly, aren't we all?
right.
So we went to the experts, the
The pros.
yeah, the brainiacs over at the National Bureau of Economic Research, the NBER,
Yeah.
and they did some serious research on this, and one of their big findings, the market is way more volatile than we think, especially when you consider this whole factor timing thing.
Yeah, it's kind of like discovering there's this hidden layer of activity happening beneath the surface.
Okay, I'm hooked already.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
I mean, first off, how could anyone possibly time all these different factors?
Oh, yeah.
It's like a zoo out there.
It is. Researchers actually call it the factor zoo for a reason.
Okay, yeah, that makes sense.
Trying to predict the movement of every single factor would be, well, it would be a nightmare.
Yeah.
But the NBER folks, they found a really clever way to simplify things.
Oh, okay, tell me more.
Instead of trying to wrangle every single animal in the zoo, they focused on the biggest, most influential ones. The dominant factors, think of it as identifying the key players in this market ecosystem.
Gotcha.
And they found that just a handful of these dominant factors could actually explain a huge chunk of the market's movement.
Really?
Yeah, like 60%.
Wow.
Yeah.
So by focusing on these big guys, these dominant factors, they could actually start to see some patterns emerge.
Exactly. Yeah, and here's the really exciting part. They found that they could actually predict the performance of some of these dominant factors.
Whoa, hold on. So they could actually predict
They could predict.
the future.
Well, in a way, yes. They use something called book-to-market ratios, which is basically a way to measure a company's value compared to its stock price.
Mhm.
And the really cool thing is that these predictions worked even when they tested them on data they hadn't seen before.
Wait, back up.
Yeah.
Out of sample predictions.
Out of sample.
That's like predicting the lottery numbers. That's wild.
It's a big deal. It means these predictions weren't just flukes.
Right. So which factors were they able to predict?
So two big ones really stood out: size and value.
Okay.
It turns out you can get a pretty good idea of how those factors will perform just by looking at their book-to-market ratios.
Interesting. And so how accurate were these predictions? Were they
They were remarkably accurate.
Yeah.
In fact, they found they could predict size and value with, get this, 4 times more accuracy than predicting the entire market.
Oh.
Yeah.
Okay, so that's pretty impressive. But did this predictability actually lead to better returns?
Right.
I mean, that's the whole point, right?
Right. That's the million-dollar question.
Yeah.
And the research seems to suggest, yes, they created a portfolio based on their predictions.
Yeah, okay.
And it performed remarkably well.
So this portfolio was basically like a fine-tuned machine taking advantage of these factor timing insights.
Exactly.
Wow.
And this is where it gets really interesting. This high performance, it suggests that the market is actually way more volatile than we think, especially when you compare it to what those classic buy and hold strategies would suggest.
So it's like we've been looking at the market through the wrong lens this whole time.
Maybe.
There's a whole other level of activity going on that we haven't been paying attention to.
Potentially, yeah. And it all comes down to something called the stochastic discount factor.
I'm not familiar with that one.
So you can think of it as the engine that determines how much investors are willing to pay for an asset based on its risk.
Okay, I'm starting to get it. So this SDF thing, it sounds pretty important.
It's fundamental.
But how does factor timing affect it?
Well, that's the key insight from this research. It suggests that the SDF is way more volatile, like nearly twice as much than previously thought.
Wow.
And it's less predictable, too.
Really?
Yeah. And this actually challenges the traditional view that the SDF is driven by slow, long-term changes in the economy.
So instead of this like slow and steady engine, it's more like a high-performance race car engine,
That's a great analogy.
constantly revving and adjusting.
Yeah, yeah, and it means that we need to rethink how we approach investing.
Okay.
Factor timing, it's not just about trying to beat the market.
Right.
It's about understanding these deeper forces that drive the SDF and ultimately drive the entire market.
Wow. Okay. So we're saying factor timing opens up this whole new understanding of the market.
Absolutely. And that leads us to another really intriguing question. If the SDF isn't just about these slow-moving economic factors, then what is it responding to?
Ooh.
What other forces are at play here?
That is a great question.
It's a mystery waiting to be solved.
It's like we've stumbled upon a whole new mystery.
Right. Well, think of it this way. This research is kind of like shining a light on the blind spots of those traditional static investment approaches. It's saying, hey, there's a lot more going on in the market than you might realize.
Okay.
If you're just relying on simple buy and hold strategies, you might be missing out on some serious opportunities.
Okay. So are you saying we need to ditch our long-term plans and become like day traders?
No, not at all.
Okay, good.
The good news is
Yeah.
the researchers also looked into how often you need to adjust your portfolio
Okay.
to actually
Uh-huh.
take advantage of these factor timing insights.
Mm-hmm.
And they found that even if you rebalance, let's say, less frequently, like every quarter,
Okay.
or even just once a year,
Mm-hmm.
you can still reap some significant benefits. It seems these factor timing signals are strong enough to be valuable, even with a more relaxed approach.
Gotcha. So it's less about timing the market perfectly and more about understanding like these underlying currents that are driving these factors.
That's a great way to put it. It's about recognizing that the market isn't just this random walk. There are these underlying trends, these shifts in factor performance that we can actually identify and capitalize on.
This is making me rethink my whole investment philosophy instead of trying to predict the unpredictable. Maybe we should be focusing on these broader trends.
Yeah, I think you're onto something.
Okay.
It's about recognizing that risk and reward aren't just about, how much you're willing to gamble. It's also about understanding the different types of risks that exist in the market and how to navigate them effectively.
So factor timing is about more than just trying to beat the market. It's about understanding the market on a deeper level.
Precisely, yeah. It's about being more adaptable
Mm-hmm.
and dynamic in your approach, recognizing that the market is constantly evolving.
This is great, but let's get practical for a moment.
Sure.
How can we actually put, factor timing into practice? What are the key takeaways for everyday investors like myself?
Well, first off, diversification is still incredibly important.
Okay, that's good to hear. Yeah.
But it's not just about spreading your bets across different asset classes.
Mm-hmm.
It's also about being strategic about how you allocate within those classes based on these factor timing insights.
So it's about diversifying smarter, not just wider.
Exactly.
Okay.
Second, we need to be more adaptable in our approach. Those static models, set it and forget it strategies, those might work in a world where the SDF is slow-moving and predictable.
Right.
But as we've seen, that's not really the reality we're living in.
So we need to be more like surfers, adjusting to the waves of the market.
That's a great analogy. Yeah, we need to be able to ride those waves to adjust our portfolios as those market dynamics shift.
Okay, so this might mean, questioning those one-size-fits-all investment products out there, the ones that claim to capture all the market's magic.
Right,
Yeah.
right, because they might be based on an outdated view of how the market actually works.
Yeah, they're not taking into account these factor timing dynamics.
Exactly.
Okay, got it.
And another key takeaway is the importance of doing your homework, of understanding the factors you're investing in,
Right.
and being aware of their potential for predictability.
So it's not about blindly following the herd or chasing the latest, hot factor.
Not at all. It's about understanding the long-term behavior of these factors, how they interact with each other, and how their performance shifts over time.
Okay.
It's about being a student of the market, studying the patterns and cycles to gain an edge.
I like that.
And of course, you always need to understand your own risk tolerance and your investment goals. All this fancy footwork with factor timing means nothing if it doesn't align with your overall financial plan.
That's a great point. It's about finding the right balance, between pursuing these opportunities and staying true to your own investment philosophy. This has been incredibly insightful. But before we move on, are there any, practical limitations to factor timing we should be aware of?
That's an important question.
Yeah.
One key challenge is transaction costs.
Right.
If you're constantly buying and selling to adjust your portfolio, those costs can really eat into your returns.
Right. So it's a balancing act between being, adaptable and avoiding excessive trading.
Another hurdle is data availability and quality.
Yeah.
To accurately track and predict these factors, you need reliable and timely data. And as you know, not all data is created equal.
Garbage in, garbage out, as they say.
Very true, very true.
Yeah.
And finally, there's the human element. Our own biases and emotions can really get in the way.
Yeah.
It's easy to get caught up in the excitement of a hot factor or to panic when things start to go south.
Right. So discipline and sticking to the plan are crucial, even when the market gets a little wild.
Absolutely. And remember, this research is just the tip of the iceberg. There's a lot more to explore in this area.
Okay, so factor timing isn't like a magic bullet or anything.
Right.
But it's a powerful tool to add to our investment arsenal.
Yeah.
It's about, diversifying thoughtfully, being adaptable, doing our research, understanding our risk tolerance, and being mindful of these practical limitations.
Well summarized. And it's important to remember that this is an ongoing journey. The market's constantly evolving.
Right.
So we need to stay curious, keep learning, and adjust our strategies as new information emerges.
Speaking of new information and mysteries to uncover.
Yeah.
In the first part of this deep dive, we talked about how the SDF is much more volatile than we thought, and how it's not just driven by these slow-moving economic factors. So the big question is, what is driving this volatility? What risks are really being priced in by the market?
That's where things get even more interesting.
Ooh.
Well, they started by asking a pretty simple question. Can we explain this volatility by just, adding one more thing to those existing models?
Okay, so like patching up an old engine instead of getting a whole new one.
Exactly. So they tested if adding a single variable, let's call it X, would do the trick. Think of X as like something that can shift the overall risk appetite of the economy.
Okay.
Like a dial that gets turned up or down.
I see. So is this similar to those models that try to capture investor habits, where risk aversion changes based on, past experiences?
Yeah, you got it. Or imagine a scenario where, like, the financial health of those big players, major banks, suddenly changes. That could ripple through the entire market, right?
Right. Yeah, affect asset prices.
Exactly.
Okay, so this X, it's like a master switch for risk in a way, but did it actually solve the puzzle?
Well, that's the thing. The research suggested the single variable fix is it's too simple.
Yeah.
It doesn't quite capture the whole picture.
Yeah.
We need to think beyond just tweaking risk appetite.
Okay, so it's a more complex puzzle than just adjusting a single dial.
It seems so.
Did the researchers find any clues about what other forces might be at play?
They did, and this is where things get really, really fascinating. They looked at how their estimated SDF, the one that takes into account factor timing, moves in relation to specific market anomalies.
Anomalies? You mean those like quirky little market behaviors?
Exactly, yeah. The ones that don't quite fit the standard models. It's like trying to identify which dancers are following the same rhythm as the SDF.
Okay.
This might give us some hints about what risks the market is really responding to.
I see. So it's a bit like detective work, looking for clues in the market's movements?
Yeah.
So which anomalies were they focusing on?
They looked at a bunch, but 4 really stood out. Size, value, momentum, and return on assets.
Okay.
ROA.
ROA. Yep. The usual suspects.
Right. But did these anomalies actually behave the way we'd expect?
Yeah.
And that's the fascinating part. They found that the relationship between these anomalies and the SDF, it was anything but constant.
Oh, interesting.
It was like watching a constantly changing dance floor.
Okay, I'm intrigued. Break it down for me. What kind of patterns did they see?
Well, for example, they found that size and value, they tended to be more closely linked to the SDF during recessions.
Okay.
While momentum often went in the opposite direction.
Oh, wow. So when the economy takes a hit, size and value, they become more important in determining asset prices, while momentum kind of loses its step.
That's what the data suggests, yeah.
Interesting. And what about ROA?
ROA seemed to follow its own unique rhythm,
Okay.
less tied to the overall economic cycle.
So it's like each of these anomalies, they have their own unique, dance move, their own relationship to the SDF. They represent different aspects of risk.
Precisely, and this creates a real challenge for those traditional economic models.
Yeah.
It means we can't just, tweak risk aversion with a single variable.
Mm-hmm.
We need models that can actually handle these complex and dynamic relationships between the SDF and these different market factors.
Wow, this is really eye-opening stuff.
It's pretty fascinating.
So if I'm an investor listening to this, what's the key message I should take away?
I think the biggest takeaway is that the market is far more intricate and dynamic than those classic models suggest. And by understanding these hidden dynamics, these shifts in factor performance and their connection to the SDF, we can potentially make more informed and nuanced investment decisions.
So it's not just about, buy low, sell high anymore. It's about recognizing the complexity of the market and adapting our strategies accordingly.
Precisely. Yeah. It's about embracing a more dynamic understanding of risk and reward and being willing to adjust our approach as we gain these new insights.
This deep dive has been a wild ride. It's challenged my assumptions, sparked my curiosity, and given me a whole new perspective on how the market operates.
I'm glad to hear it. And remember, the market is a constantly evolving puzzle. So keep learning, keep questioning, and most importantly, keep exploring.
That's great advice. And with that, we wrap up this deep dive into the world of factor timing. Until next time, keep those minds curious and those portfolios balanced.